If you watched part 1, you already know why most traders misuse the MACD indicator. Now it's time to learn how professionals actually use it. In this video, we'll cover advanced divergence strategies, combine them with price action and market structure, and analyze real trades step by step. By the end of this video, you'll have a complete framework for using MACD divergence the right way. To start, take a look at this chart. On the 4-hour time frame, the market is in a downtrend. Therefore, you should trade in the direction of that bearish move and focus on looking for selling opportunities. Next, we move down to the 15-minute time frame. This is the time frame where our actual trading setup develops. Initially, we had a divergence signal. However, this divergence was not confirmed. As a result, the market only produced a small pullback before moving higher again. For this divergence to be considered valid, the price would have needed to form a lower low, a lower high, or another type of price action pattern that confirms a trend reversal. Later, the market formed a second divergence, and this one was confirmed. At this point, you're looking for any type of price action that signals a trend change from bullish to bearish after the divergence has formed. And here's what happened on the chart. First, you could identify this reversal pattern forming in the market. Then, when the price broke below the pattern, it confirmed both the divergence and the reversal pattern, signaling a trend change from bullish to bearish. Once again, this confirms the divergence and provides a signal that the trend may be shifting from bullish to bearish. Let's look at another example. On the 4-hour time frame, the market is once again in a downtrend, so we want to trade in the direction of that bearish move and focus on selling opportunities. Then, we move down to the 15-minute time frame where our trading setup forms. Here, we had a divergence signal, but it was not confirmed because the price failed to create a lower low. Therefore, no trade was taken. The market then made a pullback and formed a lower high, which, in this case, was actually a head and shoulders reversal pattern. The neckline is drawn like this, and when the price breaks below the neckline and creates a lower low, it confirms your divergence setup. It also confirms the head and shoulders reversal pattern and signals a trend change from bullish to bearish. Now, let's take things to the next level and move on to some advanced divergence entry strategies using the MACD indicator. But before we continue, we have an important question for you. What is your favorite trading indicator and how do you use it as part of your trading strategy? Let us know in the comments below. And if you're enjoying the video, don't forget to hit the like button to support the channel. Strategy number 1, identifying divergence at a key level. Let's start with an uptrend. First, you identify your key resistance level using these 3 swing points. These 3 levels are extremely important because every time the price reached this area, it experienced a strong rejection. Now that the market has returned to this level, there are several possible entry opportunities for this trade. The first entry opportunity is right here, using this long wick candle that formed at the resistance zone. The second entry opportunity comes from this double top pattern, and the third entry opportunity comes from the divergence that formed directly at this key level. You could enter on the break of this trend line, or alternatively, draw a neckline here and enter on the breakout. Now, let's look at the opposite scenario, a downtrend. This is the anatomy of our trading setup. Let's see how it looks on the chart. Once again, the first step is to identify the key support level. When the market returned to this area, a complete divergence setup formed directly at the support level. To confirm the divergence, simply use a market structure reversal pattern. Again, regardless of which confirmation method you choose, once you have confirmation of a trend reversal, you should begin looking for entry opportunities. In this case, long opportunities. Let's take things one step further and move on to the second type of strategy. Here's the formula for strategy number 2. First, identify a significant price action move at a key level. Then, look for divergence within that price action move on a lower time frame. This strategy involves combining multiple timeframes in the market, and there are 4 different scenarios for applying this strategy. So, let's begin with the first one. In this example, we're looking at the 4-hour time frame where our setup is forming. So, let's break it down. we have a clear uptrend, which means we want to trade with the trend and with the bullish momentum. We also have a key level here. Why? Because of these two previous rejection points. When the market pulled back, a strong rejection candle formed and reacted to this key level, creating a potential buying opportunity. However, as we always say, a reaction alone is not a trade. The market can react to a key level and still break through it. That's why you need to analyze the price action inside this area on a lower time frame. Now, let's move down to the 15-minute time frame. As you can see, a MACD divergence formed here, and this is where you should begin looking for entry opportunities for a long trade using your preferred entry strategy. Let's look at the opposite scenario, using strategy number 2 in a trend-following trade during a downtrend. Let's move to the charts. Here, we're on the 1-hour time frame. We have a clear downtrend, which means we want to trade with the trend and with the bearish momentum. We also have a key level here based on this previous rejection point, when the market pulled back and reacted to the key resistance level, suggesting a potential selling opportunity. But remember, a reaction alone is never enough to enter a trade. You still need to analyze the price action within this area on lower timeframes and look for any signs of a trend reversal from bullish to bearish. So, let's move down to the 15-minute time frame. Here, we have a MACD divergence. We also have a trend line drawn underneath the price action. When that trend line breaks, it confirms the divergence, confirms the higher time frame rejection candle, and confirms the trend reversal from bullish to bearish. Let's move on to the next setup, using strategy number 2 in a counter trend trade during an uptrend. Let's go back to the charts. Here, we're on the 4-hour time frame, and as you can see, we have a key resistance level. When the market moved back into this area, a strong long wick rejection candle formed, suggesting a potential selling opportunity. However, as we always emphasize, a reaction alone does not constitute a trade. That's why you need to analyze the price action within this area on lower timeframes and look for any signs of a trend reversal. So, let's move down to the 15-minute time frame. Here, we have a MACD divergence. This is where you begin looking for short selling opportunities using your preferred entry strategy. Now, let's move to the opposite scenario. This is an example of using strategy number 2 in a counter trend trade during a downtrend. Here, we're on the daily time frame where our setup is forming. Let's take a closer look. We have a support level here, a major key support level. When the market moved back down into this area, several long wick rejection candles formed, suggesting a potential buying opportunity. So, let's move down to the 1-hour time frame. Here, we have a MACD divergence. Then, when the price broke higher and created a higher high, it confirmed the divergence, confirmed the higher time frame rejection candles, and confirmed the trend reversal. This is where you should begin looking for long entry opportunities using your preferred entry and exit strategies. Before you go, don't forget to let us know in the comments what's your favorite trading indicator and how do you use it in your trading strategy. We're looking forward to reading all of your comments.